Hello, this is Simon Thompson, Vice President and Wealth Advisor at Texas Legacy Wealth Management. We recently hosted our first client event of the year where we reviewed last year's major market events and, more importantly, our thoughts on the economy and market for 2015. We'll review and recap the main topics of that event today. Securities offered through LPL Financial, member FINRA SIPC, investment advice offered through Texas Legacy Wealth Management, a registered investment advisor and separate entity from LPL Financial. Our event was held on Super Bowl weekend, where we saw two great teams square off in what was an exciting back-and-forth game. While the Patriots and Seahawks each have their own style, they both excel at putting their players in the best position to succeed. That's what we try to do at Texas Legacy Wealth Management. Each team member plays a critical role in either the investment team, planning department, as an advisor, or as part of our Service 360 team. We're continually looking for ways to improve our level of service through each of these areas. One such improvement is the rollout of our new client portal, which gives you access to your accounts, enhanced reporting features, and easy-to-read charts and visuals. We will also be able to share documents and market updates through the portal. We're currently in the process of providing access to all of our clients. When we take a quick look back at 2014, we can see that the U.S. was a great place to be allocated, with overall returns amongst the highest globally. There were a couple of developed countries that delivered higher returns over the course of the year, but you had to look long and hard to find something better. In fact, European markets and emerging markets were both negative for 2014. This is a trend that has reversed through the first month of the year and will be something to watch closely throughout the year as we continue to invest globally. Central bank policy is at the forefront of most investors' thoughts for 2015. As we're approaching a tipping point for policy action, over the past few years, we've seen conventional and unconventional policies used around the globe in an effort to stimulate the economy. Economies around the world are at different stages, and as a result, we're seeing converging policies. In the United States, the Federal Reserve is expected to tighten by raising the Fed funds rate. Fed Chairwoman Janet Yellen has emphasized that the decision will be data-driven. Possibly, the most important piece of data will be inflation. If inflation remains below the Fed's target, tightening may happen later rather than sooner. The UK is also expected to tighten, but many other countries are headed in the opposite direction. In Japan, Europe, and China, central banks are loosening monetary policy in the hope of encouraging economic growth. U.S. bond markets also proved attractive to investors during 2014. Treasury bond yields, which were expected to rise during the year, confounded many experts by moving lower. In fact, we closed January with the 10-year U.S. Treasury yielding 1.68%. There's an inverse relationship between bond yields and bond values. As a result, when yields dropped during 2014, the value of bonds held by investors increased. Expectations for 2015 are again for yields to move higher. Seeing global growth pick up, potentially driven by central bank policy, could be a key catalyst to interest rates rising this year. Plunging oil prices have grabbed the headlines over the past 6 months or so. We don't need to look far to see why. Tepid global growth, along with surging supply, especially within the U.S., has led to oil prices around $50 per barrel as of the end of January. The U.S. energy renaissance is a theme which we will look to take advantage of in 2015, and especially see the industrial sector as a benefactor. We also see lower energy prices putting more money in consumers' pockets. We believe that consumers will spend this money in other sectors of the economy. If that happens, corporations could start to see increased revenue, and we believe they might take their revenue and look to become more efficient by upgrading their technology. Thus, technology is another sector we like in 2015. Here we see unemployment and the labor force participation rate over time. Unemployment was at 10% in the fall of 2009. It's now down to 5.8%. Despite improvement in unemployment numbers, the labor force participation rate has declined. Some see this as a sign that little economic progress has been made and the economy remains far from fulfilling its potential. They argue the decline in the unemployment rate does not really reflect an improving labor market. Others say the economy is substantially back to normal after a very severe recession. They point out the labor force participation rate has been trending lower since 2000 and suggest it reflects changing demographics. For example, the retirement of the baby boomer generation has pulled people out of the workforce. This demographic shift is another factor we're seeking to take advantage of in portfolios this year, as we see an increasing demand in medical needs for that generation. As such, another of our favorite sectors is healthcare. In allocating portfolios for 2015, the big question is whether there's a recession on the horizon. To assess this, we look for excesses in the market and economy by examining 6 forecasters, data series that have had a statistically significant historical track record of providing warning signs that we're transitioning to the fragile late stage of the economic cycle. Once we receive these signals, on average, we can expect to see a recession within the next 6 to 12 months. It's important to note that none of the forecasters currently show cause for concern, which indicates a recession and potentially subsequent bear market is unlikely in 2015. The forecaster that's flashing yellow is Valuation. As we look at U.S. share prices, they're not cheap, historically speaking, but that doesn't suggest a need to sell stocks at this time. P/E ratios are not a good timing device and simply provide guidance as to the relative affordability of stocks. While higher than average today, it's not uncommon to see valuations stay above average for extended periods of time, especially in a low-rate environment. We will continue to monitor this indicator along with our other forecasters. Thus far, in 2015, we've seen intraday volatility pick up. An increased level of volatility throughout 2015 would not surprise us, with the potential of a 10% correction at some point throughout the year. Overall, we don't see a recession on the near-term horizon and are bullish in both our outlook and equity allocation. For more information about Texas Legacy Wealth Management, you can contact us via phone, email, or feel free to visit our website. We'd also like to remind you to follow us on Twitter and like us on Facebook.